Hello, everyone, and welcome to our video on pension risk transfers. My name is Michael Clark, Chief Commercial Officer with Agilis, joined by my colleague and head of our annuity placement business, Joe Anzalone. Today, we're coming to talk to you about timing within the pension risk transfer market. And just by way of background, as I'm sure most of you are aware, there's been a continued increase in transaction volume with these annuity buyouts over the last several years, right? Really all starting back in 2012. But as we look even over the last couple of years, we've seen tremendous growth in the number of transactions that are brought to market each year. 2023 saw the largest number on record with around 850 total transactions, which is a big number in and of itself. But when you compare it against 2022, it's a 25% increase over that prior year amount, which is huge. And historically, the fourth quarter has always been the busiest, for a lot of these transactions. Joe, let me ask you, is that still the case?
Yeah. So Michael, I think there's some ways of saying yes, it is, and some others that say no, it's not, right? So I think what we've seen is that the fourth quarter has remained extremely busy in the PRT market. In fact, last year we had some participants, some insurers in the marketplace telling us, by the time we got to the midpoint in the fourth quarter, like, sorry, we can't do anything else this year. We're already so full up. So it's still quite busy. But what we've seen, and this is supported by the publicly available data, is that as the fourth quarter has stayed full, a lot of business has shifted earlier. So it's not that fourth quarter has gotten less busy. It's that the rest of the year has gotten even busier and is now taking that crown of busiest quarter, at least when we see through the lens of premium dollars. We've actually seen that be the case where in 2021, 22, and 23, the fourth quarter was actually not the busiest quarter of the year in terms of premiums dollars, the most premium dollars that were transacted. Now, some of that has to do with particularly large jumbo transactions, transactions that are multiple billions of dollars. There was one in the recent years that was $16 billion in a single transaction. Obviously, those size transactions are going to skew the numbers a bit when you're looking at it from that premium dollar lens. But it's clear that as that fourth quarter has stayed very busy, but the market itself is growing, you could argue maybe we're just reaching capacity in that fourth quarter, and now plan sponsors are starting to try to maybe get an advantage for themselves by moving their own transactions earlier in the year. And so what we've seen, the last several years now is that between 2022, 23, even 2021, either the second quarter or the third quarter probably has taken the crown for the largest premium dollars transacted. But really, all three of those quarters have been quite busy. Where we do see still a little bit of a breathing room in the market, perhaps before this year has been within Q1. So Q1 of the first 3 months of the year tend to be less busy than the others. And maybe I'll just pause on that and say we haven't gotten official statistics out for 2024 Q1 just yet, but we do know just from publicly available announcements that there were two extremely large jumbo transactions in the first quarter of this year in 2024. So even that truism that Q1 has been the slowest may change this year as we see plan sponsors getting earlier in the year try to avoid the crunch that we've seen take place over the past several years.
So, Joe, obviously with more transactions, that's more time that the insurers have to spend on these transactions, which, as we all know, you get busier, you've got human capital constraints just in terms of what people can do. So with the increase in these number of transactions, what are you seeing from the insurers in terms of the time that's required to implement a pension risk transfer transaction?
Yes, if I go back a few years to 2018, 2019, 2020 was of course a year kind of in its own category. But even then, what we saw generally is that, especially true at the smaller end of the market, you could easily bring a transaction to market, announce to the insurer, send out the specifications for the bid and the data that they need to price it out. And you could get preliminary bids back in 3 weeks, no problem, no questions asked. Again, for larger transactions, probably you want to give yourself a little bit more time than that, but that was fairly standard, I would say, on the smaller end of the market. And even at the larger end, it wasn't that much more time needed in order to bring a transaction to market. And so the final selection might be as fast as a month after you send out those preliminary bids. Fast forward to now, and I mean, that's just not going to get you the best result anymore. What we recommend to all of our clients is you give yourselves at least a minimum of 2 months from when you issue that request, that bid request out to the market, with all the data that the insurers need to price yourself. You want to give at least 2 months between that initial request out to the market and when you're making a final selection and signing a sales agreement with your selected insurer. Really, ideally, we'd say it's 2.5 to 3 months of time between when you send out that bid request and when you get that price, that final pricing date, and make your selection. And Michael, I'd point to exactly the things you said. It's not that it takes them 2.5 or 3 months to do all their calculations and price it out. It's really just a matter of scheduling. When the people who work on this are going to actually sit down and do their analysis and get their approvals from management. And actually, they update prices on bid day. They update their prices that morning, and there's only so many transactions they can price out on any given day, given the fact that they do have to run their models and make final adjustments the morning that the bid is issued. So while we understand that many insurers really don't get too deep into the pricing work until a week or two before preliminary bids are done, they still need that 2.5 month timeline in order to just get it on their calendar and line up resources so they're not double booked or triple booked or quadruple booked on a transaction that's going to be very meaningful to them if they're selected. So what happens is, if what we see, if we don't give ourselves that much time, the amount of time that you need, you end up with less competition, and we don't think that that's a good result for plan sponsors. So we always recommend a minimum of 2 months these days. And again, if you can do so, perhaps give yourself as much as 3 months between that initial bid request and when you make the selection.
But Joe, you had mentioned that obviously for larger transactions, even giving yourself more runway is optimal. So when the timelines that you're talking about here, I mean, does that apply even at the middle and small end of the markets as well?
Yeah, and I think that's a really great question, Michael, because that's another area that we've seen change a lot over the past few years. I mentioned that at the smaller end of the market, a few years ago might be typical to issue a bid request, a month before selection. I think that it would not be our recommendation these days. We think that for even sub $10 million transactions, really the smaller end of the PRT market, it's best practice to give yourself as much time as possible, just to make sure you are getting the most interest from insurers and you're not running into scheduling conflicts. What we do see at larger transactions, even in the mid-sized market, think $30 million to $80 million, still a relatively mid-sized transaction. What we do see is not only do we think that that 2.5 to 3 month window of the active bidding process is best practice, but we see more and more at that size, and this again used to only be in the realm of really large and jumbo transactions, but we see this now even in the mid market, is sending out what you can think of as a save the date for your transaction to the insurance marketplace. The industry term is a solicitation of interest, where you let the insurance marketplace know that you're bringing this transaction to market, give them some high level details on what the transaction will be, but not that full bid specification document or all the data that would include, but just letting the market know, hey, we're bringing this transaction to market soon. Will you be interested? And that's helpful for plan sponsors to know, like, hey, is this transaction going to attract the kind of interest we're thinking and we're hoping for? But it's also helpful for the insurers just to put it on their calendar and say, hey, okay, great, this looks like, we don't have all the specifics yet, but this looks like a deal we'll want to participate in. Let's mark off that date 4 or 5 months in the future on our calendars. Let's save the date for this one so that we know, hey, let's make sure we've got our resources lined up. And that's, of course, ultimately beneficial for the plan sponsor as well. So, even within that mid-market size, we think that a solicitation of interest in advance of bringing the full deal to market makes sense. And even at the smaller end, where maybe a solicitation of interest isn't standard practice, at least giving yourself enough time to make sure that you're not ruling out some insurers who otherwise might bid is our view is the best practice, that 2 to 3 month time frame for bidding.
So Joe, you've alluded to this. If somebody doesn't give enough runway to the insurers, and let's say they bring something to market and maybe they're even with under that 2 month minimum time frame that we specified, and so they don't get as many insurers to bid on this as they would, or that might otherwise bid on it, like, why is that detrimental to a plan sponsor?
Yeah, and I think it's important to note that we say our recommendation is a minimum of 2 months, but if you're 1 month and 29 days, you're not necessarily going to go from a successful transaction to an unsuccessful transaction, right? Of course, it's a spectrum, but as you get closer and closer, or a shorter and shorter time frame, and give the insurers less and less notice, you'll begin to lose insurers who might otherwise bid on the transaction. So if you have a transaction of a size and nature and where, you could expect 6 insurers to bid on that, but because you didn't give them enough notice and you're trying to do things, maybe too quickly on too short a turnaround time, and they don't have the capacity to take it on, maybe you only get, 2 or 3 insurers instead of 6 insurers bidding. Is that the end of the world? I wouldn't say it's the end of the world, right? With the marketplace is fairly competitive, and even with 2 or 3 insurers, you're likely to get a robust process and probably a good outcome. But you'll never know if it was actually the best outcome, because maybe one of those 3 insurers who decided not to bid would have been the one to give you the best deal had they participated, right? So it's really more that possibility of losing out on what would have been the optimal selection. And then of course, that's a situation where maybe you went from 6 to 3, but if you go from 3 to 1 and suddenly you have a non-competitive process where you're stuck with one insurer, take it or leave it, that can be a transaction. And again, maybe that ends up being perfectly fine and within expectations, but you'll never really be confident that you couldn't have gotten a better deal if you had a more competitive, more robust bidding process. Of course, there is the possibility that no insurers will be able to take on if you're not giving them enough time, and that's an outcome I think no plan sponsor wants to find themselves in. If they're planning to do this, they go through the work to put this bid request together, and then it turns out that there's no one interested on the time frame they'd laid out, and they have to go back to the drawing board and say, all right, I guess we have to do this another time. If it's a retiree carve out and they have flexibility, maybe that's not the end of the world, but especially for a planned termination, where there's often regulatory requirements driving the timeline, you really don't want to find yourself in a situation where there's no insurers that are interested just because you didn't give them enough time for the bidding process.
Yeah, no, that makes sense. All right, so just to wrap up here, walk us through the ideal timeline that a plan sponsor may want to follow if they're contemplating a pension risk transfer transaction.
So when we think about it from the starting point, right? And anytime you're bringing a transaction to market, right? That's itself the end point of a work stream that you, working with your consultant or broker, will have gone through in order to understand, who the population is that you want to include. Are you looking at all retirees or a subset? Are there anybody else in the plan that you want to include? Again, if it's a plan termination, understanding what the whole plan would look like, and doing any liability management exercises in the form of lump sums that might take place. So, the analysis and decision-making part of this needs to be included too. Sometimes that's a pretty easy timeline, and sometimes that can be extensive, again, if it's in the context of a plan termination where there's a lot of other things that need to be done first. So, I won't put a time frame on that before you're making a decision to do so, but just wanted to put that out there. Once you've made a decision to engage in pension risk transfer and solicit bids from the marketplace, again, we think that if it's a transaction of any meaningful size within the context of the PRT market, I'd say maybe even as little as $25 or $30 million, you want to think about, do you want to give yourself time to send out that save the date or solicitation of interest to the marketplace? And that's of course going to be competing concerns with, how quickly do you want to transact? Are there any other deadlines that you need to encounter for yourself? Very often we see plan sponsors wanting to transact before the end of their own fiscal year or before the end of the plan's plan year in order to avoid, for example, PBGC premiums for the following year. So you have to take those two things into account. But once you've made a decision, you want to give yourself, I would say, at least a month before you're actually issuing the bid request. And again, maybe more if you want to include that save the date in there as well. And then, as I said, ideally 2.5 to 3 months from when you issue the bid request to when you're actually making a selection and conducting the transaction with the selected insurer. So really, that's a minimum in our view of 3.5 to 4 months between the time you've made a decision to engage in PRT and when you're actually making your selection. Now, again, you can go faster than that, and it wouldn't necessarily be the end of the world, but we think best practice is to give yourself, that 4 months or so. And again, if you have the flexibility of additional time, maybe even extending that out to a 6-month process where you can give that insurers, that additional heads up time frame in order to ensure that you're getting the best, most robust competitive process by having insurers save the date.
That's very helpful and very instructive, Joe. So if I'm hearing you right, and what I think we want people to walk away from this discussion today with is that there's really two things. One, timing is everything. timing matters in how you think through when you're going to actually make it or bring a transaction to market. When's it going to close? There's obviously busier times of year for the insurers than others. And so timing is a critical component of that analysis that a plan sponsor needs to factor in as part of deciding to bring a pension risk transfer transaction to market. And then second, and I think you've articulated this very well, you have to plan ahead. If you want to get the optimal number of insurers to the table for a given transaction, you have to build in some of that time to let them know, to be able to tell them about the deal that's coming, and then get them information well in advance, again, so that they can calendar, so that they can have the resources available. All of this towards a successful transaction from a plan sponsor perspective.
That's exactly right, Michael. Yeah, I think maybe the one other thing I'd add to that, and it's implicit in the two things you mentioned, just make sure you're working with someone who understands the marketplace really well and can help you guide through all those things and help you understand what you need to do before you get to this step, what's going to happen once you get to this step, what's going to happen after the transaction, right? Because really we're talking about the timeline through the day you make the selection. And that's generally when we think of as the transaction happening, but there's actually a lot that happens after the transaction as well, that doesn't necessarily drive your own decision making around timing, but is important for plan sponsors to know. So just making sure you're working with an advisor who really knows this in and out and can help you through that process.
Excellent point. Well, thanks everyone for tuning in. If you want to know more information about the pension risk transfer process, fiduciary responsibilities, you can check out our website, www.agilis.llc, where you can see more videos like this. And feel free to reach out to us on our Contact Us page. We'd be happy to speak with you about your needs and thoughts around pension risk transfers. Joe, thank you again.
Thanks. Thank you, Michael. And thanks everyone for joining.